Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to accomplished UK fund manager Stephen English of Stellar Asset Management. So welcome, Stephen.
Thanks for having me on, Paul, and hello to all your viewers.
Yeah, well, it's great having you back on the show, not least given all the volatility yesterday caused by President Trump's proposed trade tariffs that he then decided to push forward by a month. But before we sort of run through your view of the equity markets, and particularly in the small caps for the rest of the year, I'd just like to have a big shout out to our sponsor today, Edison Research. They've got a really good, comprehensive stable of analysts who look after UK, European, and US stocks and do research, all freely available. Anybody wants to go into there, then they can do. I don't know whether you ever have a look at their research. Do you at all, Stephen?
Certainly do. Yeah, really good resource. No, it's paid for the company, but it's really proper, high quality stuff. So, yeah, we absolutely digest it.
Yeah, good. Yeah, no, good. So, anybody wants to have a look at those on particular stocks, then please feel free to do so. Okay, if anybody also wants to ask Stephen any questions, then please put them in the chat box and I'll read them out and we can go through those. But before we do that, given the sort of dreadful state of AIM and small caps over the last 3 years, what's your outlook going forward for that sort of like smaller, lower end of the market?
It's been thin gruel, hasn't it, Paul? Yeah. So looking at your functions on this camera, you've got to touch up my appearance. Tick box. Pity you don't have a touch up my portfolio. Tick box. I was looking at last year's video as well. The comments are quite funny, aren't they? Some guy said, ditch the headphones. You're not in the 90s. I'd just like to show him my calculator there, the HP 12C 1986 edition. 225 pages instruction book. No harm living in the past. But I thought, we'll get the jokes out the way early because there's nothing else to laugh about. But I thought I want to start with a poem, Paul. And it's taking inspiration from Baldrick and Blackadder and his German guns, where he repeats the word doom 14 times. Well, I've renamed it the Chancellor's Sums, and I'll have a go with it now. It goes doom, 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 doom. You can guess the last 3 words.
Doom, I remember that. Doom. I remember the episode as well.
Yeah, I mean, I just incandescent rage at handling of the economy by the government. Peak stress came at the budget, really, and quoting Blackadder this time from the very same episode when he was critiquing another of Baldrick's poem. It kind of summed up the budget too. It started badly, tailed off a little in the middle, and the less said about the end, the better. But apart from that, it was excellent, excellent. It's just a gas, Paul. A gas. I call it Sideshow Bobonomics. You've seen the meme with Sideshow Bob in the garden where he steps on every rake, and that seems to be what the government is doing. They're throwing every rake possible, and the economy just keeps stepping on them at the moment. They've managed to suck all the confidence out of the economy, and the momentum, which was one of the strongest, the G7 has just come to a shuddering halt. And by talking down the prospects, and then we had the anti-growth budget, which is basically a tax on employment. It was essentially an austerity budget for the private sector, and then the signal it sent out to outside investors was pretty terrible. You've got the government taking from the productive private sector and repatriating that to a bloated, unproductive public sector. And they just feel a little bit out of sync now with where the world has gone. He doesn't have too many net zero allies left. Canada, France, Germany, it's all changed there. And we are looking a little bit isolated and a bit of a throwback. And you got the Americans, we're looking on with envy there. They're embracing animal spirits. All we've got to embrace is spirit animals for some sort of emotional refuge from the trauma of it all. My spirit animal would be a sloth, a majestic creature. But capital goes to where it's best treated. We need to treat it better. I think the penny has thankfully started to drop. There's been a definite change in tone from the government. And you had a bit of, people called it bond vigilantism. I think it was more bond asboist. It was a shot across the bows, but thankfully it was, and it came hopefully in the nick of time now. So actually, believe it or not, as we go forward for the rest of the year, we're pretty constructive on the backdrop. Yeah. We think it's going to improve. The consumer's in a really, really good place financially. The only missing ingredient has been confidence, but that's a fickle thing both ways, and it can come back quite quickly. And equities are all about rate of change. And if it's getting incrementally less bad, that in itself will be a powerful driver to share price returns. And just lastly, on the AIM market specifically, we're AIM IHT managers. We've had 3 consecutive annual losses now. In the index. You've got to go back to the years 2000, 2001, and 2002 for the last time for that to have happened. What happened after then? In 2003, the market rose 39%. The market rose 20% then in 2004. So it may seem like wishful thinking as we stand here today. Year to date, the market's down. But I personally think we'll get a big fill-up from interest rates. We're going to get a cut on Thursday in all likelihood. But I think the signalling, hopefully, will be a lot more dovish than is being priced in at the moment. We're only looking at 2 cuts this year to end at 4.25, but Roger Lee, the economist at Cavendish, has got it spot on. We are much more like Europe in our growth than we are the US, and Europe will be at 2% in no time with their rates. So why on earth should we be still at 4.25? So rising rates suck the oxygen out of small caps over the last couple of years, and I think that reverse dynamic is going to happen now.
Yeah, well, there's another sort of very famous investor adage that you buy on the sound of cannons, going back to that Bullridge episode. And given valuations are so low in small cap, then yeah, I mean the outlook. You just need the delta, isn't it, to get less bad and start. If it can start to actually improve, then we should see some really good sort of returns. Okay, let's. Yeah,
sorry, it reminds me a lot of the 09, 010 setup, because you look back then and you say, why didn't you buy that? That was just giveaway.
Yes. The
problem was there was 100 or 200 other stocks that were exactly the same level of cheapness, and it almost becomes too much and overwhelming. And these things become valuation traps, not value traps. Valuation traps, because people say they're just too cheap and they're going to stay cheap forever. Of course, they never do.
Yeah. No, I'm really positive on the small caps, no doubt about it. Okay, good. Let's move to one small cap. Let's look at the veterinary services firm, CVS Group, that has come down a lot over the last 3 years. It's roughly around about halved, largely on the back of Competitions and Markets Authority investigation that seems to be ongoing. Came out with a trading update, and it seemed pretty flat, but they're looking at a slightly better outlook in their veterinary practice. How do you see this one? Because it's not only expanding slowly in the UK, but more so actually in Australia.
Yeah, spot on to highlight the CMA. It's been a big overhang. We're due working papers in the next few months. May's the likely month for their initial findings. Often that first draft bark is worse than its bite, pardon the pun. But the remedies then are subsequently, normally as a precedent, watered down by the time the final report drops, which is due in October. So we don't have too much further to wait for hopefully a major clearing event to come through. You've got to have a view on the likely outcomes of that CMA review. Now, very often, we've spoke previously, Paul, that stock markets are inherently poor at pricing in a known negative unknown. They often assign far too high a probability at too high a cost, so it's a double whammy. And for what it's worth, we think the CMA's options are going to be much more sunlight remedies. So this is more an issue of transparency and information rather than something much more draconian. That would certainly be in keeping with past investigations. So maybe pricing disclosures on very common drugs treatments, who owns the practices, make that more transparent and clearer for people, rather than really draconian price control on drugs or prescriptions, or even forced divestments of its other businesses like the labs or the crematoria. There's a possibility of a prescription cap, but that would be entirely manageable. We feel they would just have to put up their consulting fees. So it's a bit like whack-a-mole. If you reduce it on one part of the business, it has to rise on the other. And we've taken quite a lot of heart from the government, becoming a lot more forthright now with the regulators, encouraging them to focus on growth, not just risk. They also basically ousted the chairman of the CMA last month, replaced him by an ex-UK Amazon boss. They were unconvinced that the CMA was sufficiently focused on growth. So that augurs well, hopefully, for the upcoming review in May. Now, less positively, the CMA have said they're not going to include goodwill when they are calculating ROCE to see if this industry has been over-earning. So for acquisitive groups like the major corporates, goodwill is a key component of the balance sheet. So by removing that, it's going to bias upwards the optical returns on capital employed artificially so. Now, we're hoping that common sense will prevail. PAMUR if you fold in the goodwill, they calculate that CVS is only earning 180 basis points spread over its cost of capital. Now, that is hardly excessive and definitely not evidence of any sort of market failure. It has impacted trading. Like for likes were down 1%, but to the credit, they held EBITDA margins at 20%. They've been undertaking a very painful IT project rollout called ProVet. This is a digital operating system, ERP, but also a CRM for their vets practices. That takes vets away. They have to learn to train it, but longer term, that will give them automated appointments, online booking, upsell, food plans, and the like. So it should be additive to growth once we get through this. So good time to do it. Don't let a good crisis go to waste. If you're already in a hole, just throw some more negativity at it. So there has been an impact on consumer behavior, undoubtedly. There's been an impact on vets. They've been a bit more circumspect in what they're prescribing now. But thankfully, they do have Australia. That's only 15% corporatized, whereas versus 55% in the UK. They're spending 50 mil a year there. Their balance sheet is okay. Net debt EBITDA is below 2 times. It's in a much, much better place than some of their larger PE listed, who are 6, 7, 8 times. We know they are suffering. Their model did not have negative like-for-likes in, and they are making redundancies. Staff morale, you would bet, is quite low, whereas staff employee reviews recently were actually very, very good at CVS. So long story short, all of that has conspired to absolutely wallop the rating. We're on 7 times now, EV, EBITDA. That's pricing in really the worst of the worst outcomes that would be possible. Apparently, you'll see £18 in pretty short order on any sort of benign CMA outcome. So look for the initial report in May. It may sound bad. It may trigger a bit of a sell-off. I think that would be a really good buying point for people.
Yeah, no, I would agree. Got a question follow-up from Ben Sharman asking about CVS. He says, why have you chosen CVS and not Pets at Home? I can guess, but what's the answer?
Quite a simple one. It's Pets is an AIM.
Oh, I see. Right. Okay. I thought it'd be the retail side of it because it's more retail.
Bit of that too. I don't think I would have owned it either. I mean, but we're their streets because retailers have been using digital tools for decades, and they're miles ahead in terms of the online experience. That's really, really slick. And their like for likes were astonishing. I think they had 20% vet like for like in their recent report.
Yeah. Well, we haven't got long to wait for the CMA report, let's say, May time. Good. Let's move to another company in that same sector. Anpario came out with a better than expected trading update just recently. It does sort of like it's a manufacturer and distributor of all natural sort of like animal feed additives. And sells right across the world, actually. It's into the Americas, Asia, Europe and stuff. I don't know whether it's actually going to be impacted at all by the tariffs. I'm guessing not. But anyway, what's your latest on Anpario? The shares have done brilliantly.
Yeah. Thank you for that chart, Paul. Thanks for not putting a longer term one on. Looks much better. It's very well placed. Structural megatrend, natural feed additives replacing harsh chemicals. We still use quite a lot of formaldehyde in feed and zinc oxide. You've also got the bans on antibiotics as growth promoters. So farmers are having to now look for natural alternatives, and these products works with the animal's natural gut to improve their health, their feed conversion, and the yields and profits at the end of the day for the farmers. They've also got products that reduce methane and carbon emissions. That's a good growth area for them too. They had gone through a perfect storm on recent trading. Normally their geographic and species diversification offsets each other with zigs and zags, but it was such a homogenous shock from COVID first, then the Ukraine war, and then extreme food cost inflation for farmers and energy cost inflation and fertilizers. So the economics of farmers really took a battering, which really impacted volumes for Anpario, and their own acid input costs rose precipitously, and they really found the limit of what they could charge for their products with farmers. I think that limit came earlier than they actually thought. So volumes fell, and this is a capacity utilization business. It's got high fixed costs, so we went through a very punishing downgrade cycle. That's now very much in the rear view mirror. Volumes are recovering, and that's now driving strong operational gearing. We had a recent update in January. It was the 5th upgrade to numbers. So revenues over the full year up 21%, EBITDA 47%, operating margins up nearly 400 basis points now to 14%. So that's the operational gearing coming through, and earnings per share up 50%. I want to talk on this one on capital allocation. because they need plaudits because it's been excellent. Capital allocation over the long term is really the only thing that's going to dictate where you go, and if you're going to be a fantastic company or a poor company, if you do capital allocation well or not. Not enough CEOs do it well, unfortunately. So after the downgrades, they did a £9 million tender offer in July 23, and that's the way to do it. One big lump, not this drip, never daily buybacks where they never really complete them because the volumes just aren't there. Actually, they had to because two fund managers were forced sellers because it was a 40 mil market cap at that point. So they were either going to smash the price to bits or you had to take them out. So they took them out. That was at 225. We never sold a share in that tender offer, even though it was at a premium. Fast forward today, the shares are up 84%. So it was an excellent use of capital, reduced the issued share capital by 17%. It was that significant. And then they followed it up with a fantastic acquisition in the States. They've been trying to get acquisition over the line for a long time, and they've always just missed out. And this is actually their fifth acquisition since inception in '98. It's a lovely deal, $6 million BioVet. They only paid 6.5 times EV/EBITDA. Normally, you'd be paying 15 times, but the founder really wanted to sell to Anpario. They saw him as a good home. The key technology there is capsule in a capsule. It's a leading delivery mechanism for incompatible ingredients to be delivered in a single dose. Gives them access to the US market, gives them manufacturing capability, gives them cross-sell opportunity. Still got 10 million quid net cash on the balance sheet, and we're starting to see buying patterns normalize. So demand is still now recovering, and they've got potential blockbuster drugs in aqua, specifically targeting shrimp, and actually looking to move into ruminants as well. And long term, they want this group to be 25% aqua, 25% ruminants, 25% pigs, and 25% poultry. That would really help with the overall balance of the portfolio.
Yeah.
So you've got the shares 40% below their peak in 21, even after that run that they've had. But FY24 earnings per share, 25p, was actually higher than the record in 21. So if we just get back to where we were, you're looking at 65% upside. Another way of looking at it, we're only on 10 times EV/EBITDA. The 5-year average is 14 times EV/EBITDA for this. And if you look at the forecasts, SureCap have actually got operating margins falling 100 basis points, which is just not going to happen when you've got rising revenues and rising volumes, given that capacity utilization, where they're only at 30% capacity at the moment.
Yeah, no, I mean, it looks like I didn't realize they haven't got some really neat technology. That capsule in a capsule is really leading edge, and certainly I might try some of the methane reduction tablets myself. Actually, that sounds like an opportunity for me, particularly if I've been out for a heavy night.
Mrs. Hill will be grateful.
I know. Just on the animal theme, we've got a question coming from Zoo Look. He's asking about Treatt, which is the flavors and fragrances group that's just been going through a turnaround. They've got a new CEO, Dave Shannon, who's come in. I don't know whether you own that particular share, but it does seem to be now moving into the right direction. It's owned by Lord Lee, I think, as well.
Yeah. I do. I own it PA actually, and now I'm going to embarrass myself by having a pretty lamentable investment thesis for why I own it. But I liked how well invested it was. I think there's, don't need to spend any more money now from here. It's just getting that top line going. So there's big operational gearing. You can see a common theme in my investments here, Paul. We love operational gearing from a self-help point of view. They're looking to broaden out their offering as well. Perhaps they've been a bit too exposed to tea. There's much broader applicability to flavors, fragrances, and the like away from their core citrus offering. And I like the cut of the jib of the CEO as well. He sounds like a pretty blithe statement, but management for small caps are the most important element of your investment thesis. So I see good upside on that one. If it's going to stay around here, you wouldn't be surprised to see a big premium paid for that.
Yeah, exactly. Some private equity or trade buyer put a number on it, and it's benefiting secular growth, as I understand, by the whole move to sort of like less alcohol for the generations Z, Z and people wanting to have healthier drinks, and therefore they like flavor drinks and this sort of stuff, and therefore it plays presumably to its strengths. Okay, let's move to another one in the healthcare, animal healthcare. We've got Animalcare, in fact, which does sort of like pharmaceuticals for vets and stuff. It's got a big position, I think, in dental drugs and also pain relief, but just bought really quite a transformational business, Ranlab, out in Australia, which has made it into really has transformed the vision, the whole company now going forward. Trades at a pretty reasonable valuation too. How do you see this one going forward?
Transformed is the right word to use, Paul, on this one. It's transformation. We've been waiting for a good number of years. I know Mr. Mills is a big fan of this one, and we share his enthusiasm. Yes. Taking a step back, they've radically improved the business. This is a classic case of, you know, commercially, operationally, strategically, you've overhauled the business, yet it's yet to fully feed through in the financials. So these are great setups because the financials will inevitably now catch up to that progress that they've made. And we see growth now set to accelerate and really benefit from the scale benefits that will unlock operational gearing now, really for the first time, because they've done really well tidying up the group. They got out of a long tail of pretty marginal products post Equifarm merger. They've improved gross margins, but they've put a lot of OPEX investment. They've really improved the quality of staff. So actually at the operating margin level, it's been held back. That's why I'm saying the financials have been lagging, but we've really built a solid platform here for the next level of growth. We were just waiting for this type of acquisition. Now, they got themselves from 2x net debt EBITDA post Equifarm to 30 mil net cash balance sheet. They sold Identicare for a wonderful price, 25 mil. They sold their STEM JV as well, but kept the commercials on that. It was a fantastic deal for them. And then this Australian business, Ranlab, which was a little bit left field, they only paid 11x EV EBITDA, which is an incredibly attractive price for this type of asset in that sector. We know the PE boys and girls who lost out were spitting feathers. They were prepared to offer higher prices. But again, it comes back to founder-led businesses wanting to find a buyer who will nurture the business now for another 10, 20, 30 years. That's the great thing about public markets, just an aside. You never see great businesses built in private equity because they've got a 5 and 7 year horizon to hit the IRRs. Whereas public markets, that's where the great businesses are built because they've got a perpetual timeline, essentially. The forever owners. So it's an equine business. It's 70% gross margin, so it's higher than Animalcare. It was immediately 20% earnings per share accretive. Yet here we are today, the share price has shrugged and it hasn't moved. So you're getting a bigger business now for less. They did a £20 million raise at the same time, which was interesting because they have kept their powder dry. We know they have a very live, active pipeline for further M&A. Now, what this gives them the capability is a beachhead in Australia. They're not going to change the focus of Ranlab from equine, which is a really attractive sector. It's growing high single digit. There's a lot of pricing power. Customers are well heeled. It leans into the thoroughbred market in Australia, which is the second biggest in the world, and also the polo market over there. It gives them much better balance. They've got 22% exposure now to equine, which is the highest across any of its peers in its industries, even the big boys. Essentially, they've got de minimis. So they're really the only one of a scale targets in equine. So it's a really good franchise now to build out a companion animal business on the back of over in Australia. And we think there's 3 options in Australia that are pretty live and they could be pretty imminent to really take us on to the next level there as well. They'll start then to license the drugs in Europe into Australia. It won't be immediate. It can be a 2-3 year wait, but that is now ahead of them. And we talk about a flywheel. Once you get to critical mass, it starts to spin faster and faster. It's getting them closer to their 100 million revenue target. At that level, you're looking at 20% EBITDA margins. That provides you more profits to invest in sales and marketing. That allows you to invest more in new product development as well, and it's a virtuous cycle. So R&D now is going to rise to 5% of sales from 2 to 3%. They have been capital constrained while they repaired that balance sheet, but that is no longer the case. So we see this as potentially the unlock moment, kind of what Decra went through. Decra was a nano cap. It grew and grew and grew. It was acquired at over a $4 billion market cap in the end by private equity who paid 25x EV/EBITDA for Decra. Interestingly, Animalcare's chairman was one of the founders of Decra in 1997, and he had 13 years exec director experience at Decra, and he has got a fantastic black book of industry contacts. He's been there, he's done it before, he's got the playbook. So even if we're at a quarter as successful as Decra was, you're looking at a pretty meaningful upside here on this one. It's trading at a 25% plus discount to peers. We think that's unjust. We think we're going to see now an acceleration in top and bottom line growth, and yeah, it's a really core hold in this one.
Yeah, and they do seem to have done a terrific job. That whole capital allocation, getting disposing of certain companies that weren't core, and then putting it into something that is a real growth driver, allowing that cross-regional synergies. And the gross margin 60 for the group over 60% is fabulous. Okay, well, let's just we'll tie a bow on the animal stuff. We've just got the last one. We've got Echo Animal Health, which much smaller business. I think it's about sort of like 44 million market cap. Does sort of like drugs for or antivirals and vaccines for pigs and poultry. How do you see this one? The gross margins here are significantly lower, actually, which just surprised me. It's about 40% or so. I mean, still good gross margins, but not as high as over 60% plus.
Yes, well, thank you. That margin piece is a key part of the story here. So avlosin is a best-in-class antibiotic. It's a modern antibiotic. You only need to give it in half the dose compared to its larger peers, and it's got a 0-day withdrawal, so you can slaughter the pig or poultry immediately. So it's a lot more economic for the farmer to use. It's got a 20% market share. It's the third biggest in its sector. That said, it's sold in over 70 countries, but the share price of Eco Animal Health for far too long has traded like a geared warrant on the Chinese pork price, for better and worse. So it's been incredibly volatile. The market's basically saying avlosin's X growth. You can easily make a case today that the market cap should be appreciably higher just for avlosin. That said, if it was just avlosin, I wouldn't be talking about them, and I wouldn't be invested in them, because there's a much more interesting story now that's starting to gestate. A new CEO came in April 22, and he sought to change the fortunes by investing significant sums, 10 to 12% of sales per annum, into its new drug development pipeline. So this started 3, 4, 5 years ago in earnest. There's been no dilution. So the good thing about avlosin, it's funding future growth now. So it's self-financing this future growth. So you're right to highlight the margins. They're at 40% at the moment. The previous has been at 50%. Their key ingredient, API, rose a lot during COVID and the Ukraine war. It's now falling in price. It's going to fall 8% this year. That's about 2/3 of its costs of goods sold. So it's very, very impactful. So margins are going to get a bit of help there, but I don't see them rising much beyond 45% now in the medium term. But the new products are very much focused on vaccines, and vaccines are structurally much more attractive than antibiotics. They are typically 60 to 80% gross margin. So as these flow through and start to commercialize, you should see the group gross margin rise. And the other key attraction of a vaccine versus an antibiotic, especially now, is you can only use antibiotics. You're only supposed to use them to treat a sick animal, whereas vaccines are given to every animal to prevent disease. So the volumes are much higher as well. So they've got a decent balance sheet. Some cash is held in China, which puts some people off, but they've proven that they can get that out of the country. Even excluding China, they've got 8 mil, so there's no problems there. Unfortunately, the first new products we were looking from this pipeline to treat mycoplasma, which is a chronic respiratory disease in poultry, they were guided to launch this year, but that's now moved to FY26. The US regulator has asked for more information. It's always a risk with new drugs. More positively, though, management are cognizant of that disappointment, and they are looking to out-license those 2 products to a bigger player. They've had unsolicited inbound interest to out-license those products. Now, that would be a key endorsement of the technology before it's commercialized. You could have stage payments, milestones as you get closer and closer. It just brings forward sales and profits earlier. And I've spoken to the CEO. He said one shareholder quipped, "I'll be dead before you commercialize any of these new products." So it answers that accusation. So the valuation's really tricky here.
Yeah.
On the one hand, they spent 50 million quid on these new drugs, and they haven't sold anything yet. That's going up 10 million pound a year. Should you fold that into the sum of the parts? Management have a net present value of the current drugs pipeline on the risk basis of 200 million. as it stands versus 44 mil market cap today. I just think you've got completely free options on pretty transformational growth potential here. Their biggest drugs are actually the next three beyond that. These are the big blockbusters. One of the biggest they're targeting is peak sales of 60 mil, and then another one 44 mil and another one 37 mil, versus only 15 and 11 mil for the first two products. One of them is actually targeting PRRSV, which is the same disease Genus is trying to treat through its gene-edited pigs. Now, the market's huge, costs about $1 billion a year to farmers from lost pigs due to sickness. So the size of the prize is very, very big here. Management, now this may seem like hyperbole, on a 3 to 5 year view, they see EBITDA rising some 90 million versus 8 million today. Now you've got to be patient. It's not overnight. These things can miss. Their first three, though, there's now an 80% probability of success. They're de-risked.
80%. I was going to ask you, in terms of the hit rate of new drugs, how do they get an 80% probability of success?
Well, it's all evidence based. So once you've got the proof of concept and you've got the dossier, it's almost linear the way the probability goes up. Now that the drug actually works. It's not to say it's an 80% probability of hitting their commercial aspirations. It's one thing to bring it to market, it's another thing then to sell it. So that, rightly or wrongly, these first two drugs next year, the market is going to extrapolate success or failure right across all the other 8. There's 8 products in total. So the other 6, these are successful, they'll say, brilliant, all of them are going to be successful. If these fail, they're going to say, that's rubbish, all of them are going to be a failure. Even though each technology is completely distinct, there's no bleed across to any of them whatsoever. So it will be volatile. Might not rush out today, but certainly I want to put it on people's radars. It could be a multi-bagger.
No, great idea. Just on that lead drug they currently have that's funding all the R&D, do you know when the patent they have expires on that one?
Yeah, they don't have one.
Oh, right, they don't have one. Okay.
which may sound scary, but actually, so Randlab, Animalcare, that's pretty much all generic as well. The great thing about the animal pharma space is with generics, it's just not the same as human drugs. You don't get the same patent cliff issues where people rush in and collapse your sales overnight. Now, while it's off patent, what's really, really difficult is making it. It's the cooking process to come up with it. That's the secret sauce, and that would really challenge competitors.
The cooking. Okay, good. Right, let's got a question from Richard Wavell. He's basically asking about Oxford Metrics, which did sell a big division off about 2 years ago. Got a lot of money. I think it was anyway. They've got now a sort of like I think it's a sort of like a digital video type 3D visualization software systems that they do for a lot of the big movie centers and shows and this sort of stuff. I don't know if we've got any thoughts on Oxford Metrics at all, Stephen.
Yeah, I mean, it's just a ridiculous amount of net cash now on the balance sheet, 40 odd mil. You've got an EBITDA. Talk about these valuation traps. It's a bit like, two economists walking down a road and there's 50 quid note on the pavement and none of them pick it up because they say if it was real, someone else would have picked it up. And that's just kind of the situation here. If it's real, well, someone would have bought it by now. So let's move on. We really rate the CEO who's came in, Imogen. She's an engineer. She's been at Vicon, which is their traditional business, motion capture. So the green screens, the blobs. There's a new technology coming through, markerless, so you don't need to put the blobs on anymore. It's called a large vision model. So there's an AI angle to it as well. It'll be a higher recurring revenue model versus Vicon, which traditionally has been more of a capex model, so one-off type sales with the Valkyrie cameras. It was them who actually did the ABBA Voyage. I've still yet to get tickets for that. It was their technology that created the hologram experience. That's brilliant. There. What they did really well during COVID, because the video games, who were a key customer, had massive success. The budgets exploded. Then that normalized. So like-for-likes have gone backwards. But Vicon has been around 40 years. It's the market leader in what it does. And you can acquire this thing now for an EV/EBITDA of 2 and a bit times. I just never thought I'd see this. There's buybacks going on. There's M&A. We know they're looking, and they've already made some moves now into more adjacent markets and smart manufacturing, where there is applicability between their current motion measurement and smart manufacturing as well, where you've got humans and robots working very, very closely with each other. You know, in Tesla factory, there was a robot arm that put a guy through the wall a couple of years ago.
Wow.
So if you can detect an arm, maybe that's getting too close and it could break a human's arm and kill it dead with the camera. There is symbiotic cross sell they can do there, and they have made moves. I think what would be helpful here is a better articulation of the strategy and the M&A strategy in particular. I would urge them to look at MPAC and their slides, the way they have distilled their M&A strategy. It's very, very precise. It's really easy to understand. I think Oxford Metrics could learn a trick off them on that. I think that would help unlock some of this latent value.
Yeah, well, I mean, coming back to the first comments you made on the market outlook with Echo Health and with Oxford Metrics, sort of really good, high quality IPR heavy type of companies trading at all-time lows, then there doesn't need much good news to really sort of move that share price dial, because nobody's looking at them really.
Yeah, precisely.
Yeah. Okay, good. One company that's done pretty well actually for you over the last 12, 18 months is Eleco, which is sort of like a build tech software, project management, visualization software developer for sort of properties and infrastructure for stuff. They do seem now to be getting that top line growth, having gone through from a perpetual license to a SaaS model. How do you see this one going forward?
I should ask you, Paul. You know it better than me. You've been investing in it longer than me. The
Yeah,
mega trend.
I've only been on it for 10 years.
Well done, you. The mega trend is increasing digitalization and adoption in the construction and building sector. We know they're notoriously slow to adopt new technologies. That is changing. You know, complexity is ramping up. There's more regulatory demands of data management and sustainability and safety and dispute resolution. This is all grist to the mill for demand for Eleco, who helps solve for all of those pain points. The recent update was encouraging, 16% top line growth, 9% of that was organic, and really nice to see they've effectively finished their SaaS transition, which has been 3 years in the making. They're now at 77% recurring revenue from 56%. They've handled it really, really well, because how many software companies have we seen go through that J curve where the J never inflects and it just gets deeper and deeper, the hole, because it can hold sales back while you're going through that transition optically. So done a great job there. Now there's an increase in focus on the top line coming through. They've got the bandwidth to look at that. I think the key is going to be penetrating the huge US market, which is only 5% of Eleco sales. They are up against some gorillas, but they're, likes of Oracle. These products aren't specialists. They're not designed to do what Eleco can do. The hardest part is trying to change behavior for someone who's been using Oracle for 20 years and trying to persuade them to use Eleco, but that'll happen. Maybe one project at a time, but by hook or by crook, it'll happen. I think they can lean on the value-added resellers over there with a bit of consultancy. So they don't need to spend a fortune on their own sales force. They can leverage off some pretty good channel partners, and they're looking at that area. And you've got ongoing M&A.
Yeah.
Last I spoke to them, they're seeing 2 companies a week in the £2 to £5 million revenue range. And it was really nice to see the PMAC acquisition in Ireland, which opened up a new market for cross-sell potential. It's a maintenance management software. It's a bit like the Shire system software, where it's focused on the regulated industries, food, beverage, life science, and healthcare. It brings 100 new clients to the roster, which is always lovely for the salespeople to attack there on the cross sell. And likes of Coca-Cola and Heineken, these are the clients that they're now dealing with. They've still got 13 mil net cash. They've just gone through 30 million of sales. We always see that as a big Rubicon actually in software. You tend not to get the operational gearing coming through until you can punch through that 30 million glass ceiling, and then you really start to accelerate. So we see this as a key inflection point now. This is why we alighted on them last year. It's a 90% gross margin business, so the drop through is very high. 22% EBITDA margin, the scope to tickle that up. 25% certainly. I mean, you whisper it, maybe even 30% at a bigger size. And certainly 100 mil revenue, you'd thinking they'd be doing at least 25% EBITDA margin. And I always push them, what's their 10-year sales view on this thing? And they're very, very coy, Paul. So I'll have to ask you offline whether they've let you know. All he said is they are forecasting significantly in excess of 100 mil of sales ultimately from this machine. So even if it's 100 mil, you get at 25%, it's 25 mil EBITDA versus 7 mil EBITDA delivered in the year just gone. So 3.5 times potential uplift in the medium term, and it won't stop there. So we think there's a bit of tidy up on the portfolio as well. The visualization and CAD are a bit of the odd man out businesses. They're quite lumpy. They're 24% of sales, and I think it would really improve the quality of the group if they divested that. And 2.8 times EV to sales is just the wrong price. It should really be between 3 and 4 times, I think. So split the difference, 3.5 times, it give you 180.
Yeah. Well, I mean, just the gorillas in that industry, Bentley Systems, Autodesk, and Immense Check, all trade between 9 to 11 times sales, simply because of the high gross margins and the value that you can generate for your customers with that SaaS revenue stream. So there's still a big arbitrage. If ever they got somebody knocking on their door, there's plenty of upside. Okay, in the similar sort of software or sort of bit of hardware as well sort of sector, we've got Tracsis, which is basically the poster child for all things digitization in the rail network. And this used to be an absolute darling, came out with a profit warning during the general election because it disrupted some order flow. And then it bounced when it said it'd seen that normalized. And since then, we haven't heard much from the company, but the shares have just dropped like a rock. And largely, I guess, on the back of worries of this Great British Railway entity being set up by the government that is absorbing all the rail franchises. That's led to sort of like some profit warnings from other businesses in the rail sector. We've had Renew, Costain, Speedy Hire, I think Van L likewise and stuff. How are you seeing this one now? It's either a super value play or still a value trap, but how do you see it?
Yeah, it's come right off the rails, hasn't it? It's been, they've got a bit of work to do to hit FY25 numbers, undoubtedly. The market's saying you're not going to do that. So they're priced in a profit warning, which may or may not happen. They are due to report 26th of February. So maybe one for the brave to get in ahead of that. Hopefully, I don't hear from them until the 26th of February. Otherwise, it's going to be bad news. But it's still a good business. It hasn't deteriorated to that extent overnight. I think management were perhaps guilty of over exuberance on the pipeline, which was up 200% by July last year. The pipeline value had increased 200%, and they were getting really, really excited about converting that, particularly in America. But it hasn't happened. Now, Labour election was outside their control. That killed the last 2 months of their financial year, and that it was the kind of beginning of the end from it, where we've gone through this painful and downgrade cycle now. But taking a step back, they've got the data analytics, consulting, and events business, which is more than half of revenue, but only 23% of EBITDA. It's the events business, kind of counting people, traffic management for Glastonbury and the like. It's an analog type business in a digital business. So if you could get rid of that, which is about 30 mil of revenue, they could get up to 1 times for that. And then really, they've already got 20 mil net cash on the balance sheet. Then go after the augmenting the rail side even further, where they've made this US acquisition. It's given them that beachhead there. I spoke to the CEO probably this time last year, and private equity was salivating over that US business and saying, "Can we buy it off you? You're the gatekeeper to the entire industry." And he said, "We know, thanks very much, but no, we're going to keep it." So that hasn't deteriorated either. What's happened is the unions have got involved, to push back maybe on some of these products, but if they can unlock some of them, there's potentially 30 customers for one product, their computer-aided dispatch product. The contract sizes are kind of $5 to $10 million. So you only need to sign a few of them to get going. We know that they are the preferred bidder for the government's so-called tap converter. This is the plumbing for pay-as-you-go. So the back end, Trainline could use them, Uber could use them. They provide the entire back end pricing for pay-as-you-go. You do it daily, then even after a week, they recalculate it. So if you got it cheaper, it'll be automated delay repay, where they're the market leader as well. What hasn't been helpful is the transport secretary having to resign. That's just delayed signatures as well. And also just this kind of impasse now between getting the Rail Delivery Group spun up. You got the nationalisation of 25 plus train operating companies as well. While that's all happening, unsurprisingly, they're not investing in new kit. So remote condition monitoring devices, you measure voltages and the like, they're just not investing in them. That's quite lucrative for Tracsis. So there's a lot that's been outside their control. But if you look at the core business, if you only put that on 9 times, that's the current enterprise value. So you're getting the services business, which is 3 mil of EBITDA for nothing. We're actually, for a vertical specialist market leader, you should be thinking more like 15 times as a commensurate valuation for this one. So maybe mind your eye in the very, very short term, but class is permanent on this one. It does have, actually, if you look at its entire product set, which is applicable for the train operating companies, it's applicable to Network Rail, it's applicable for PAL4 BT in terms of the supply chain, applicable to the freight companies, both in the US and the UK, and it's doing more with less. It's actually safer for operatives as well. The entire playbook is exactly where Labour wants to take the rail industry. It's just this air pocket, this gap in the meantime is causing this ultra pain because people are very, very much focused. If there's going to be a profit warning, forget about it. Let's sell it, get the profit warning out of the way, and then I'll buy it type thing. Share prices at the moment are very, very correlated to very near-term earnings per share forecast. So you look at these DCS, the DCS just don't work. You know, people aren't bothered about the cash flows 10 years hence into the future.
Yeah, no, it's got a great balance sheet. Just approximately, I mean, it does about 80 to 85 million of turnover. Approximately, what percentage is exposed to those rail franchises that effectively aren't buying anything at the moment at all because they've got no incentive to?
I'd have to do the sums again on it.
Okay.
The rail side's 77% of EBITDA. Initially, they were very, very sanguine about the nationalisation because it wasn't holding up contracts at that stage. But the change of government has just delaying now signatures. And actually, because it wasn't their money, the train operating companies were quite happy to sign up to new kit. But that's just changed for the time being.
Yeah, no, it's bound to, no doubt about it. I think actually there's something in there. I remember having a look at their presentation. I think there's something in there which gives you that figure anyway. So I might have a look at it later on. Okay, good. We got a question from Ben Sharman. He's asking about Fever Tree. I don't know whether you own that one. I'm guessing you may. Well, I don't know. I think it's Delay. Anyway, they just came out. They basically do the all natural. What do they call them? Basically, those accompaniments for cocktail mixers. And they just came out with a big deal with Mawson Calls, I think, last week that sent the shares up. They've got a big opportunity out there to expand in the States, I believe. I don't know whether you could say a few words on Fever Tree at all.
Yeah, I used to own it. We cut it kind of mid last year. We were just getting concerned about the actual demand outlook long term. We think it's ex-growth in the UK now.
Yeah,
definitely from a volume perspective, it is. You know, the gin craze has been and gone. They are trying to spin up new product development, pink grapefruit for palomas and the like. We question the half-life on these products being as long-lasting as the tonics were.
Yeah,
they've pulled a bit of a Deus Ex Machina intervention there with that deal. I didn't see that. Now it's great on the one hand. It seems like a royalty model, so margins will rise. It'll unlock a lot of working capital, and it solves their production issues, which have been holding them back in America in one swoop. And what a partner to go with. So that's great. Then they've issued shares to them, but then they're going to buy them back at a higher price, which is maybe less great. And it's basically a poison pill now. It really narrows the potential acquirers down, you would suspect, given Molson's stake on that register. But it probably increases the chance of Molson's eventually buying them. So puts and takes there. Fair play. It's one of those deals that are so complicated. You need to sit in a dark room and think about it for quite a while.
Yeah, no, it certainly looks like an interesting potential opportunity. Okay, good. Let's move to another sort of class company. Does software for hospitals out in the US. Obviously, it's been presumably the hospital sector and the pharmaceutical sector has been disrupted heading into that US election. But now that we've got a bit of stability, I presume that the company Craneware is better placed now to grow. It's unusual that it's actually listed on AIM for a US software business, actually.
Yeah. So don't be giving them any ideas, Paul. Brooks McDonald are leaving. Gamma are leaving AIM.
Oh,
I've seen
yes.
Mortgage Advice Bureau today are thinking about leaving AIM now.
Yes.
So yeah, no ideas, please. Otherwise, I won't have any stocks. Yeah, COVID. You know, the hospitals had to hunker down and just survive and just keep patients alive. So the last thing they wanted then was to think about buying new systems. Their own economics, you know, a lot of them were loss making for a stage,
Yeah.
so they were under quite a lot of pain. That situation now is very much stabilized. You're right, it was always going to be temporary, but it held back growth in the short term, and that
Yeah.
really hurt the rating for a while on Craneware. We actually think some people were running the rule over this quite seriously at
Yes.
their lows. It's you know, it's an enterprise class strategic asset. It's really coveted because it's such a rare bird. Um, it wasn't helped also growth by them transitioning their product set to cloud only. You know, this is a customer base that is traditionally on-prem, but actually they got through that quicker than a lot of people thought they would. And now it makes cross-sell and upsell a lot easier. You don't need to wait for the traditional license to run out before you now approach the customer. They're doing it mid-contract. Would you like to take this module now? Would you like to extend it for X amount of time? So it's been really, really helpful, and that's coming through. We're seeing a return now to double-digit top-line growth. Management said that would happen, and we've got the evidence now that it is. The hospital's P&L is now in much better shape, and they themselves have said they're looking again at spending structurally on systems like Craneware. And you've got a wider move in the US healthcare. You know, they spend typically twice per capita on healthcare than most of the Western hospitals, but have a much worse life expectancy. So there's a move to so-called value-based care, which rewards better care rather than the quantity of care. You know, you can go in with a splinter and you'll come out with a blood test, a urine test, an
Yeah,
MRI scan,
exactly. Yeah.
everything. That's, you know, only semi-joking on that one. So you get punished now if the patient represents within a very short period of time. That wasn't a good outcome, so that affects how much the hospital gets. And incredibly, the US healthcare industry spends $500 billion on non-medical operational costs. So this is basically admin. You know, using a lot of spreadsheets because the complexity with the
Yeah.
insurers and on the pharmacists on the drugs pricing, just trying to get the money back is incredibly painful. These things are code. You got tens of thousands of different codes. You know, to put some plaster on your arm, that'd be one code, and it's just that's what Craneware is really good at, and it's automating that. And
Yeah.
actually, Craneware reckon they save their customers £1.5 billion per year, and there's a 5 times return on investment for its software. So really compelling. Their average hospitals per spend per hospital has gone from $20,000 many years ago to nearly 100,000. It's a classic land and expand. It's very modularized, their suite, so it's really easy then to upsell. And they think if their current suite now, if they can sell all of those modules to just their existing client base, revenues will be over 7 times higher than they are today. If you fold in new customers who will be undoubtedly won between them, they see the upside as more like 12 to 15 times the current revenue run rate. They've done a tie-up with Microsoft, which was hugely interesting. That'll leverage their AI capabilities. Microsoft needed a partner, and Craneware's data lake, which is 200 million patients built up over 20 years, is best in class. So Microsoft are getting access to that. The operating hospital metrics and also the drug purchasing data is unsurpassed in terms of the depth of that data lake, and they're also giving them a lot more support for a companies of Craneware's size from a cybersecurity point of view than you would normally get from Microsoft. They're spending $50 million a year on R&D, 28% of sales. They're capitalizing a lot less of that, so the quality of earnings is rising, and it's just a fantastic platform now. They're opening up the platform to third parties who've got some wonderful, innovative products, but because they're tiny, they've got no chance of ever penetrating the 12,000 hospitals, who is the customer list of Craneware. So they're getting them on the platform. The clipping revenues as a revenue share from that, that's already $14 million and growing like a weed. And as we get more evidence of a recurring element of that, that's going to feed into their ARR, which is already $172 million. So this is a business of real scale. It's in the rule of 40, 30% EBITDA margin with double-digit growth. That is really rare in the UK software space. Comes back to this being a really rare asset. Yet it's only on FY26 EV EBITDA of 12 times. This thing normally is 15 times plus, and if someone bought it, they'd have to be paying 20 times plus.
Yeah, and also, the barriers to exit or entry are just enormous. Once you're in there and people are using it across the whole hospital, then it's part of the infrastructure and it's part of the actual, staff uses of it. So it's going to be there forever. Okay,
that's it.
Another stock.
40% market share they've got, Paul. With
Have they? Oh wow, okay.
For this tiny company in Edinburgh, it's marvelous. I don't know how they did it.
It is good, but they should relocate to Birmingham. Okay, another company that's done really well for you, Beeks Financial Cloud. They basically do sort of high performance for software and cloud systems for exchanges and for fund managers to give them sort of like high frequency access into these exchanges and stuff. They won a big deal about 18 months ago, 12 months or 2 years with Johannesburg Exchange, and they backed that up with the biggest of the lot with NASDAQ probably 12 months ago, and they announced it recently. Shares have been great. How do you see it going forward?
We've been tracking this since IPO in 2017 for no other reason initially that I'm just a massive Trading Places fan. And so when I found out it's named after Clarence Beeks, I was just delighted with that. And I just read Flash Boys at the same time, so I thought I knew everything about high frequency trading. But things kept moving to the right, as it does with growing businesses. The cash flow was always weak. I was a little bit concerned for a stage that customers were just outsourcing their CapEx liabilities to Beeks to Ware instead. But sometimes there is just one statement that truly, truly transforms the proposition. And you've got to be, as an investor, a bit like a trapdoor spider. You've got to be permanently waiting and ready to pounce when that one statement comes through. And you want to see the share price really gap up aggressively to confirm that there's been a wholesale fundamental change. And when that statement dropped last year, the shares rose 47%. And that's great because that actually puts off a lot of people. And they'll say, well, I'll wait for it to come back. Well, actually, if you waited for it to come back, it never did. And you've missed it. So it initially rose to 140 odd. We bought it eventually at 167. And it's just carried on going up from there. And then you rewind to Feb last year on that statement. So they announced a $2.3 million proximity cloud expansion. That was evidencing their land and expand with a tier one bank. The big one was that conditional award with one of the largest exchanges in the world, which was the worst kept secret in the world. We found out pretty quickly it was NASDAQ through public filings. They're calling it proximity on demand, NASDAQ. And it also delivered 3 consecutive halves of free cash flow. And that was really evidence of business now that had matured to the next level. We'd had niggly placings. The share count had expanded 35% post IPO. But now we've had 3 consecutive halves of free cash flow. Soon as free cash flow starts to go positive from negative, that really firms up the models for a lot of analysts in terms of the visibility improves. So your cost of capital, the discount rate you put on them can fall. And also the value of that free cash flow is just more assured. So you improve your DCF metrics there as well. And then they saw FY25 as trading significantly ahead of expectations. But crucially, that didn't include the NASDAQ contract. So exchanges for years have been offering co-location. So you can rent power and space, and you can stick your own cabinet into their own data center to get literally within meters of the matching engine. That's where all the exchange activity takes place. It's just a big computer. The closer you can get to that, the lower the latency, and milliseconds literally is the difference between billions of dollars of profits or losses for these guys. But Beeks offers their customers, or the customer of the exchange, or the customers, a simple, cost-effective cloud version of co-location. So it saves complexity. Don't have to buy their own hardware, software, or use their engineers. It saves the CapEx outlay as well. The exchange love it. They white label it. They sell it on behalf of Beeks. For Beeks, Exchange Cloud is much higher contract value than their traditional proximity cloud. It's typically £3 to £20 million contracts versus 1 to 5. NASDAQ, now this is the whale that we've all been waiting for, and it was great to see them finally confirm that it's gone live and they're onboarding now by the end of Feb, they should have onboarded some clients. NASDAQ already we think about $400 million a year from co-location, but they were running out of space. The thing with co-location is it's incredibly inefficient. You can literally have a cabinet with only one rack being rented, but the exchange has got to provide them power for the whole cabinet, whether they use that power or not. So Jayberg was one of their earlier adopters, Johannesburg. They started at a 2 to 5 million contract value. They filled the capacity twice, such was the demand. Now the contract value, total contract value is more like 15 to 20 million. That is serious, even though Johannesburg is only the 25th biggest exchange. What it's told them, though, and they've actually managed, they were going to spend $5 million expanding the size of the data centers because they were running out of space because it was so inefficient. That's told Beeks that the emerging market opportunity is actually probably as big, if not bigger now than the developed market exchanges. And that's new information for us, for the market. There's quite a few emerging market exchanges that are already top 10 in size. So each of them can at least, we suspect, rival Jayberg's total contract value now, up to 20 million quid. Yeah. And back to Jayberg, on their traditional co-location, they were charging $3,500 per month per cabinet. And they were actually making a loss on that because they were 90% empty. Now they're able, through Beeks Cloud Colo, fill the entire cabinet up, so every rack is used, and they're now earning $50,000 to $60,000 a month from that same cabinet. So transformational, the economics for Jayberg, and that's why you can see it's almost a case now of why wouldn't you use Beeks as a white label rather than trying to sell it? And we've seen this dynamic before. When it changes to why wouldn't you, you're missing out on money. This is additive. It's not cannibalizing traditional colo for them. And we start then think about NASDAQ. There's no reason at maturity NASDAQ won't be able to charge $1 million per month per cabinet. And there's no reason why they wouldn't ultimately end up with $30 to $50 million, 30 to 50 cabinets in the fullness of time. So we're hugely excited about the upside, even after you've already had this prodigious growth here. We know that Gordon MacArthur wants to sell the business at a certain point. He wants to go to Brazil and live on the beach. Hopefully he doesn't take his lovely watch with him there, or he's insured it at that point. He's not insured his watch. For the best watch in the city, Gordon has. But so we're waiting for NASDAQ's size of contract. We think as a base case, it's 15 mil. Every 10 mil of incremental sales from here is worth about 40 to 50% earnings per share upgrade. So potentially you're looking at a big upgrade now to out year numbers from NASDAQ. Every 20 mil of new sales, so every, only another Jayberg, you're looking at an 80 to 100% earnings per share upgrade. And there's 24 plus customers to target, and we know they're in advanced discussions with some leading exchanges. So I thought he'd sell it at 300 mil, 350 mil EV when it got to about 70 mil run rate. I was looking at some bulletin board last week, and apparently he's looking for $1 billion now.
Wow! I must admit, if you've won Joburg and you've won NASDAQ, then you're going to get a lot of inbound calls from other exchanges, because that'll definitely raise their eyebrows. And plus, if the value proposition has now turned to why wouldn't you from trying to sell, then that makes it absolutely lovely. Okay.
Referenceability is huge. It'd be great to see the LSE sign up. This is a British company, for God's sake, support them. Why is it it was the New York Stock Exchange, Jayberg and NASDAQ. Why are they early adopters? What's the LSE doing?
Yeah, well, I could guess. Okay, let's move sectors. We've got building products. We've got Epwin, which basically does much more mundane, I guess. It's sort of like doors, windows, and other sort of housing sort of products. They came out with a trading update just recently, and they're seeing an improving trend from September onwards. Is this can you say a few words about this whole sector and also about Epwin?
Yeah, we're starting at the sector. If you look at the last cycle from the great financial crash to a couple of years ago, it was all about the house builders. They were making tech margins of 20% plus operating margins without doing much at all. Basically, they enjoyed a very, very benign cost inflationary backdrop at the same time as house price inflation kept coming through. It was the gift that kept on giving. Volumes didn't grow at all, really, over that decade plus. It was all about house price inflation. So they made out like bandits, and Help to Buy was just the biggest gift ever from the government. But the suppliers into them didn't benefit anywhere near as much. If you compare the share prices, you're looking at two completely different industries. You wouldn't think that you were related at all.
Yeah.
We think this cycle is going to be very different, and we think this cycle is going to be predicated much more on volume growth than the previous cycle. Now we don't see them getting anywhere near Labour's aspirations, but even so, volumes will likely trend higher this decade than they did the previous. With higher rates, rates are falling, but they'll probably bottom out at a higher level than we're seeing. We don't see the same extent of house price inflation, but more importantly, you're already seeing warnings in the sector from cost pressures. So that's both labour and also suppliers for materials. And that's coming at a time when the market is nowhere near tight. So imagine what the market's going to be like when it tightens up and the builders are going full throttle. So we think they're going to have a much lower margin story, the builders, in this cycle than they did the last cycle. And as a corollary of that, they quite happily run fortress net cash balance sheets because the margins were super normal and the ROIs were still fantastic, even though they were carrying such unproductive cash on the balance sheets. This time, we think the margins are going to be structurally lower. So to goose their ROEs, they're going to have to take on debt. So we actually see a lower earnings, lower quality business with a higher financial risk, maybe at the margin, but it's something for your viewers just to maybe think about. Target the suppliers rather than the builders in this cycle. So for Epwin specifically, this is kind of the business you want to own 100% of because it's such a cash machine. The management have returned significant sums through dividends and more latterly buybacks. The issued share capital is down 5% since 2023. Just to add some more context on that cash generative ability, since 2014, the company's generated 215 million of cash, 215 mil of cash. Wow. They've spent 62 of that on acquisitions, 76% on fixed asset expansion, and they've returned 58 mil in dividends and buyback. Interest and tax was 33 mil and have taken on 15 mil of net debt. The company is very, very well invested. And in fact, their plant and machinery is insured for 250 million quid versus a book cost of only 30 million pounds and a market cap of 124 mil. So inflation is good for these types of industries because you would need now a fair chunk of capital to properly enter this industry at scale. Trading has been held back. We know that it's been well publicized. The UK construction markets have been pretty insipid, but recovery is expected by the industry this year, but it's probably going to be more H2 than H1. Epwin is 70% focused on the RMI market, so repair, maintain, improve, rather than new build, which is only 30%. So it's been more resilient. The net debt EBITDA is very comfortable, 0.5 times. They've made 2 recent bolt-on acquisitions, and they're looking at generating on average 13 mil free cash flow each year over the next 3 years. So there's ample firepower to continue adding new products there. They've got new products that they've developed as well, but the launch was held back due to COVID. That's now unlocking. You've got aluminium windows where you're seeing actually now strong demand, people moving away a little bit from UPVC, and they've also got PVC decking as well. So we think there's good growth for those products there. And you've also got more recycled material finding its way into this. And they made a really astute acquisition a couple of years ago to recycle these old UPVC windows and frames. Half of that recycled material they use for their own purposes, and the other half they sell, and the majority actually they sell to Genuit, the other listed company.
Oh, I see, right.
Okay. Their underground pipes they're using there as well. So weak macro, looks like the organic growth hasn't been great, but to their credit, they've actually added 87 mil of organic growth since FY13 to FY22. Over that time, they also lost 2 major customers. You may remember N2.
Yes.
Went bust. And then there was a division of SIG, which was sold to a competitor, so they lost that business. And they also deliberately exited 24 mil of low margin business as well. So they're all one-offs, so they won't repeat. So we see growth structurally CAGRing at a higher rate than it has previously. Operating margins are nicely back now to 8%. This is again a capacity utilization business. They're currently at 75% utilization. It will only take a modest improvement in volumes to get to 80%. And we think that should be good for kicking margin 10% from 8%, which isn't in any of the forecasts. If you look at the forecasts, they're only looking at operating margins to be held steady now at 8%. And again, that's despite still further recovery in volumes and revenue. So we see them as there to be beaten. They make a 16% return on invested capital. You get a 6% dividend yield, which is paid out of an 11% free cash flow yield. And the PE is 8.5 times. And
yeah,
I'll give you one stat. Their operating profit has gone up 20% from COVID to 23 versus their average peers, where their profits have gone down 10%. It's actually a really much higher quality business, this one, than you would think at first glance.
Yeah, and it makes a dividend yield. I think it pays one of about 5.5%. So there's a lot to like. If anybody wants to have a bit more of a dig around on Epwin, then there's plenty of broker information on the Edison website, as I've just shown here, and lots of articles and broker notes. Okay, let's move. It's getting sort of quite late now. But let's go for the last company that we don't hardly ever talk about. Is M&C Saatchi, the traditional advertising agency. I think came up with the original Thatcher "Labour isn't working" slogan, and is now sort of like turn itself around. How do you see this one in the sort of the digital marketing stroke advertising landscape?
The turnaround started, the chair came in, Zilla, ex-Future fame, took on the exec chair role for a while. The CEO now joined last year, is really high quality, ex-head of marketing at Channel 4. Before that, chief brand and marketing officer at BT. Before that, 20 years at Procter & Gamble. He was actually a customer of M&C Saatchi. So we really like him, think he's a great hire. I think the CFO, who they brought in last year, is a good foil as well. They've moved on from the fixing stage, which started in 2019. They're now much more in growth mode. And I think you're now going to reveal a more stable, long-term growth, higher margin, low capital intensity business with better cash conversion. That should be grist to the mill from a re-rating perspective. You're going to have less volatility of earnings, which should command a higher rating. They've completely overhauled the go-to-market. They've taken a lot of costs out. They've got a regional first approach now, so they're really nimble and they're winning some really nice new accounts. But perception is reality. People still think this is an advertising business when it isn't. And we'll come on to that shortly. They've taken 10 mil of costs out, which has been really good for operating margins. They touched 14.5% in H1, which was the highest level in 5 years. There's actually scope now to move on to high teens as they continue with their efficiency drive and get the top line growing even more. And the key is there's two divisions here. You've got the traditional advertising part of the business, and you've got the newer, faster growing specialisms division. Now, specialisms makes 20% plus margins, and it's already 62% of the group's net revenue. Advertising is only 8% margin. So it's specialisms is more than twice the margin, and it's growing quicker. So it's becoming a bigger part of the group. It's already 3/4 of profits.
Have you got an example of what a specialism is?
So they do a lot of work. So passions, they call it. So they do a lot of work connecting. There's a real merging of sports, music, entertainment, and brands. So Adidas will want to affiliate itself with certain pop stars or sports teams. It really engages people. Maybe if someone Real Madrid, can you get a halo effect from that for Nike trainers or whatever it is? So they connect passions in that respect. But the actual gem of that business within specialisms, we think, is something called the issues business. It's essentially acyclical, doesn't really wax and wane with the vicissitudes of the economic cycle, and it's doubled in size over the last few years, and it's already 20% now of net revenue. So they do a lot of work for NATO, the likes of NATO. So NATO asked Saatchi to do a campaign across Europe to engage young people, because a lot of young people don't even know what NATO is, what it stands for, why was it created, why is NATO a good thing, why should we care about it? So they're connecting that's an issue for NATO. So they've solved that issue by really putting it front and center in people's minds. The issues also has the likes of the World Health Organization as a client and the Foreign Commonwealth and Development Office.
Gotcha.
You need very high security accreditation to work with these people, unsurprisingly, and that's a key barrier to entry. So that's structurally growing, that specialism side of, and that's good for organic growth, where we had actually 3.5% like-for-like growth last year, which in that sector was pretty phenomenal in terms of relative outperformance. H2 even grew against a very tough base. You've had the sector derate. These things are now on a free cash flow yield of 10%, despite a lot of self-help that is still ongoing. The scope to improve operating margins in Africa, APAC, and America from 10% currently. In the UK, they do 25%. Now, I don't think they'll get UK 25%, but you can see there's clear upside to come from there as well. And you've got it all on a net PE of 9 times. You're going to have M&A returning. They've learned the sins of the past. The previous M&As were never integrated, and they also left this put option liability. So they had a lot of minority interest pay away, which was really hurting the net income line. Now, there's only that liability to the put options was 30 million quid a couple of years ago. It's only 6 million quid left, and they're going to fully extinguish that by FY26. So you've only got minority interest, only 6% of net income now. It's been falling all the time. By FY26, it'll be 0. So 100% of net income will be coming to shareholders of Saatchi for the first time in a long, long time. And that removes a complexity on the balance sheet that puts some people off as well. And, you know, they've had 2 bids knocked back previously at 207 and 247 from Vin and Next 15. So, you know, it's the brand. Saatchi is still a globally renowned brand, and it's not surprising. It's attractive interest. And what is it, 180 now, the sticker price there. It's just, I think it's a nice one. It's far less cyclical and much higher quality than people think.
Good. Okay, brilliant. Well, I've got one final question for you, Stephen. In terms of the sort of the one stock that sort of gets the pulse rating for the rest of the year for 2025, what would it be? What one of them we've talked about, or another one at all? Difficult question.
Vic Plum.
Victoria Plumbing.
Yeah.
Oh, right. Okay. Yes.
Absolutely. This is right up there. Own it PA as well. So this was a infamous class of 21. It was a wheels and warehouse business, floated at the wrong price. It was too high, but the baby was thrown out with the bathwater, which creates the opportunity. There's not many in that industry who did positive volume growth last year. These guys did 3% volume growth. Offsetting that was the average order volume fell 4%, but that's because people traded down to Victoria Plum's own brand. And this is a really nice natural hedge in the business model. So as people trade down, sales fall, but the gross margin rises because their own brand is 20 percentage points higher gross margin than the third-party brands. So they make 55% gross on theirs versus 35% gross margin on the third party. They've got a good, better, best curation of products. So there's a real choice. There's 36,000 products across 150 brands. No one can touch them. The secret sauce of this business is that margin structure. It's a 50% margin business. That's 10 points higher than peers, and that allows them to spend 30% of revenue, 90 million quid a year, on marketing. It's an unfair competitive advantage. The bulk of that is going to pay-per-click on Google, but they're increasingly doing offline brand building. So they sponsor Bolton now. They sponsored the UK Championship. So the CFO, Dan, turned up looking dapper in his velvet jacket there to present the trophy. It was absolutely resplendent.
That's the snooker.
It is. Yeah. And they're looking at darts now. And there's a very deliberate reason for that, because they're increasingly targeting the trade customer.
Yeah.
So the trade sales went up 8% last year. Trade is still only 23% of sales today. They're targeting 30%, but really, if they index to the sector, it should be more like 50%. Now, the cost of acquisition versus the lifetime value for a trade customer is pretty compelling, to say the least, because you've got the app. It's a walled garden. You only acquire them once, and then they use their app more frequently than you and I would. They order at higher average order value as well. So it's really compelling economics. And the true unlock here is the new distribution center that they've just moved into late last year. 540,000 square foot. If you wanted to, you could put 10 football pitches in it. You
Wow.
wouldn't want to, but if you wanted, you could. We visited it and we were blown away by this thing. You know, some cathedrals you walk into and you're overwhelmed. This thing is another league, absolutely. So it's allowed them to exit some very expensive, smaller centres.
Yeah.
They're keeping one for tiles and they're keeping one for returns. And this thing, they didn't go for the gold standard on automation, otherwise it would have fallen over. What they've gone for is kind of a silver bronze initially, but this is Kaizen in practice. So you know Kaizen, it's continuous
Kaizen,
improvement. Kaizen.
Yeah.
This machine they are tinkering with literally every day. They're finding more and more and more what they can do with it from an automation point of view now with the forklifts. They know exactly. So this bath will always go in that bay. Whereas previously in the previous distribution centers, anywhere where there was a space, they'd shove that bath and then try and make a note where they kept it. It was ridiculously inefficient, but they were locked at 300 mil of sales. Now they're unlocked, they can do 600 mil of sales. And we actually think over time, the EBITDA margin can rise from 10 to 15%. That will take EBITDA from 30 mil to 90 mil. As they target these adjacent categories of tiles and flooring and heating and kitchen. You know, the CEO's got a stated target of putting Topps Tiles out of business, and I wouldn't bet against them doing that. They're going to do the exact same playbook: good, better, best, 3 different pricing options. 80% of it is own brand. That's the secret sauce here. I keep saying it. That is the secret sauce. And the total addressable market of these new adjacencies is roughly similar to bathroom, 1.5 billion. But it's only 10% penetrated online versus about 30% for bathrooms. So there's structurally, there's more people going to buy tiles and flooring online. The most relentlessly driven CEO I have ever met. So they spent nearly 50 million quid last year on that on distribution centre, and also buying Victorian Plumbing, their copycat. So for the first time, they've been a thorn in their side for 24 years. For the first time, Victorian Plum can throw their marketing dollars at it, and they themselves, they alone now will benefit. Whereas previously, when they spent a lot of money, Victoria Plum benefited, and it pushed up the cost because they were bidding against each other as well. So the CEO is absolutely delighted now. It's the first time in 24 years they can just get going. They haven't been advertising the adjacent categories really at all, but sales rose pretty strongly last year. But they're quite a small part of the pie at the moment, but that's only going to go one way. I think if you ask in 3 or 5 years' time, what's the next big hairy goal? They'll probably in-house logistics, maybe. That'll make sense. And I see European expansion happening as well. So we need a French equivalent of Lawrence Llewellyn-Bowen. Who's been put to pasture.
I was just thinking of a sort of like a Queen of France or something like that would be Francois Antoinette Plumbing or something like that. I'm not sure. Okay, absolutely. Yeah, absolutely brilliant there, Stephen. Thanks very much. And I certainly wouldn't have guessed Victorian Plumbing. In fact, I've hardly ever covered it. So that's a great idea that people can.
Well, I've been encouraging them actually to get involved with Mellow as well. So hopefully, because there's a really strong story here, structural growth, bit of cyclical growth will come back as well. If rates start to fall, you'll have that benefit as well. But it's really all about the structural growth here. It's underappreciated, I see. And you got the founder and his family still own 50% of it. So there's a big alignment.
Yeah, brilliant. Okay, well, thanks everyone for your questions. Again, a big thanks to our sponsor, Edison, for helping us keep the lights on, and a triple thanks for Stephen for all his comments and insights. And look forward to chatting in about 6 months' time.
Always a pleasure. Thanks for having me on again. Cheers, Paul. Take care, everyone.